This is November 2018 and another edition of the Zacks Ultimate Strategy Session, just one of your benefits as a Zacks Ultimate member. And this month, John Blank and David Borun try to agree to disagree on whether the midterm elections will turn around the October 2018 market correction. Sheraz Mian, Kevin Cook handle the portfolio makeover. Kevin Matras back with the Zacks mailbag. And don't forget top stock picks and more. But first, John Blank and David Borun have their fundamental and technical market views.
I'm Zacks strategist David Borun, and I'm here to give you my technical view of market conditions. A quick note before I begin. You're probably aware that a lot of technicians will use simply price data and nothing else to make their predictions about the market. I tend to use it a little differently. I use it as another tool to confirm or deny or to give me the appropriate level of confidence about my market forecast. So today I'm going to be focusing on the NASDAQ 100. And my first chart here, I'm actually using the triple Qs because I'm going to make the chart look a little bit more like a couple of the components of the index that I'm going to be talking about. So you can see I've got the 50 and 200-day moving averages. And for the majority of the year, we stayed right at or right above the 50. Until we hit that rough patch in October where we dove right below the 200, hovered around it a bit, and then took another hit. This is the chart for Amazon. You'll notice it looks almost exactly the same. Little bit less steep right here in October, but essentially the same chart. And this is not a surprise because Amazon, with its gigantic market cap, is a big portion of the NASDAQ 100. And then Apple, the other big component of the NASDAQ 100. And you're going to see again, same movement throughout the year. Apple hung in a lot better in October until we got that disappointing report, and then Apple started to take its own dive. But notably, Apple has not gotten to the 200 yet. I took a look at some of what the moving averages mean as far as giving a buy or sell signal. And so I used the moving averages for 6 different periods, 5 through 200 days, and I used both the simple and the exponential moving average. And you'll see the signals kicked out there are exactly split. 6 are buys, 6 are sells, with the conclusion being that there's really not a clear indication of market direction here. This is a neutral signal. Back to the Qs here. One more technical indicator. You see we had this rising channel throughout the year. Started with a little bit of a rough patch in the spring, then kind of got in a groove and stayed in this channel again until October, and now we've fallen out of it. Now, this is not necessarily bearish. What this means, though, is that the rate of increase is likely to be slower. We're likely to stay a little choppier, and the rate of the rise of the stock market is going to be a little slower than we've seen. This is the same chart. So falling out of the rising channel is a confirmation of my prevailing fundamental view, which is that we're in for a little bit of volatility. It's not bearish for the markets. I think we're still headed up, but it's going to be slower. And I see midterm support 6,900, and I see resistance around 7,600. So inside this band, I wouldn't be surprised to see almost any daily move. I'm David Borun, and that's my technical view of the markets.
All right, John Blank, fundamental market conditions. I'm going to roll fast today, so let's keep it moving. Number one, catalyst for a midterm relief rally. Obviously, political uncertainty. We need to get it out of the way. However, we've got Mueller coming up. Remember, Mueller is a big source of additional uncertainty that we didn't get rid of. It is unusual to this marketplace. However, most of the time, October, November, and December are the best return months for an election year. We're in one for a midterm election year. This is good news. And you also have the S&P 500 PEG valuations, price earnings growth valuations level, back to 2015 levels. So you got a 3-year pullback in valuations. On top of getting rid of the uncertainty, I am bullish through the next 3 months, and I'm going to show you why. This is the basic point. Number one and key is you can see over the last 50 years, once the election is over in a midterm, the markets take off. Number two, I pointed out this PEG valuation level at 15 levels. Look at what's happened. We have gone up, and now we're going down in valuation. That is incredibly good news for people who want to buy in and give buyers a new reason to get into this market. Number 3, we've got momentum. Now, this is the chart of the S&P 500 relative to its average look. And yet what you can see is we're definitely below and testing a low in this marketplace. It's not showing a buy signal or a sell signal. It's neither. But you have to like this positioning when you add the midterms into the story here. Now, here's another point I want to point out. Inflation itself, while we have had good payrolls, is actually quite subdued. And you can see that here with the tips being below their long-term average. So this, if this was above the red line, this is the Treasury inflation protected securities line. If this was above the red line, we would have some issues here with too much inflation. We do not have that and have not had that for almost 8 years. So this is the good news, probably lower rates than people think. And here again, looking at all 3 types of rates out there, you're seeing some modest rise in the Fed funds rate. We're going to see another hike here in December. But if you look at this versus where we ended up at this point in the cycle, when we're at 4.5, or that one when we're at 6, these things are very different. This is still an accommodative market from an interest rate perspective. That's what I want to keep people in mind of. Equity risk premium. This is what I want to point out here, which is this slide, is that right now we have one bear case that needs to be pointed out, which is equity risk premium is pretty low for this market. There really is not a lot of reasons from an equity risk premium perspective to buy the market. That is one of the things to worry about, the equity risk premium. So that's it for me. I hope you liked it. My basic point is I am bullish on valuations. I'm bullish because of the midterms, and I'm bullish because I fundamentally believe there's still enough life in the cycle to play another year worth of the bull out. I think if you want to worry about the market, look to 2020 or at least no earlier than the third quarter of 2019. That's it for me, John Blank.
We'll see if John Blank and David Borun can agree to disagree right after this list of recent Zacks Ultimate top movers.
Hi, John Blank and Dave Borun with Zacks. We're going to do the Agree to Disagree segment today. Just for an understanding here, this is the day after the midterm elections. So we thought we'd take advantage of that. I'm going to be the bull and explain to you why I think markets are going to rise after the midterms. And Dave is going to be the bear and explain to you why he thinks the stock markets have a lot more trouble than that. So I'll open with this idea, Dave, that uncertainty has always been in the game with any midterm going back to 1950. That's 70 years of data. And in midterm years, after the election, all the earnings, 90% of the earnings in the stock market come to play in those last 2 months. I am convinced this is no different than any other midterm. Impeachment, policy, nothing matters other than the midterm's over. That's why I'm bullish.
Okay, well, John, despite the name of this segment, I don't totally disagree with you right now because I agree. We took a lot of uncertainty out of the way. I think that the way this election turned out was basically what most people were expecting, and I think there's a lot of positives to how it's gone. But here's where I do disagree with you. I think that we are going to see some serious policy changes and possibly even some other wild card issues with the government going forward. And I think those could have some serious effects on the stock market that's going to cause more volatility than I think you might be expecting over the next 2 years.
So why I don't agree with you, Dave, is I think, I'm an economist, by the way, so people should understand that, but I think you're going to see a divided government. And all the things you're worried about volatility-wise are just not going to happen. So I think that's going to be the good news for the market, and the market's going to take any division, any lack of policy as a good thing.
Sure, and that is a good thing. And gridlock for the markets is a good thing. Midterms have been the stock market does historically well after the midterms.
So then why are you bearish?
Because I think that there are a few things that are coming that are going to cause people to...
Such as
the possibility of an infrastructure bill.
Infrastructure.
Right? So
tell me why.
both parties are into the infrastructure bill, right? This seems like something they can probably get done. And it's obviously going to be a boost for materials, industrials.
So why is that bearish?
Because if it starts to happen and people come to expect it, and then they get wrapped up in their squabbles and it doesn't happen, we could see a serious reaction, a correction reaction in those same names.
So what about campaign finance for them? Democrats are going to open up with that. I see that as a good thing for this system because my basic bull thesis beyond the uncertainty is that what really was at stake in this election had nothing to do with policy or the economy. It had to do with checks and balances that have been restored to the system in meaningful ways. So campaign finance reform, vote suppression, gerrymandering, all the issues of getting effective, coherent, transparent government are back in play for the United States. That's bullish tourism. It's bullish students coming here again. It's bullish investment. It's bullish trade even. So that's why I think beyond this stuff on uncertainty, it's bullish. And I want your answer to why you don't think so.
It's the same story, and I agree with you on all those issues. Those are important political and social issues. Those are not necessarily the ones that I'm focused on as far as the performance of the equity markets. What I'm thinking about more is the possibility of healthcare reform. That's going to cause a lot of uncertainty. That could make drug companies perform very well or very badly. I'm looking at the possibility of investigations, impeachment talk, all the political nonsense stuff that's just going to rile the markets all up.
So where do I get a correction out of what's your biggest chance for a correction here in the next 2 months?
All right, so I think the worst one, which I left for last, is I think that the new House is probably going to start looking at increased banking regulations. I don't know what their success is going to be getting that done, but that's going to be a significant headwind for banks and financials if they take up that cause.
So you think banking regulation comes into the market that people see, they're already beating down stocks. They already have plenty of headwinds to begin with.
Sure.
So you're just saying this would be another headwind and this would take the market down.
Absolutely. It's going to move those stocks around, right? So just the same way I talked about infrastructure, if there's legislation for increased banking regulation, it's going to hurt those stocks. If the Republicans can smash it, it's going to help those stocks, but they're going to move. That's what I'm getting at, is these stocks are going to move. I'm not long-term bearish across the market. I just think we're going to see more volatility and more movement out of what happens going forward.
Okay, so I'm not against any of this, and I agree that volatility is what you're talking about. But you still haven't answered my basic question, which is I'm already put a 10% correction in the market in October.
Sure.
Right?
Yeah.
So we're already at lows. We're already at 15.5 on a forward look on the S&P 500. So how do you get me into the mindset of believing you in a meaningful way to go to 14.5 on the S&P 500 PE ratio in the next 3 months? That's just completely out of line with history. It's completely out of line of a history with a divided government. It's completely out of line with 20% annual earnings growth in the marketplace. It's completely out of line with some of the long-term structural improvements in infotech that are driving all the growth stocks that have been beaten up that I think these markets are going to get piled into. I think the hedge fund shorts of the last 2-3 months are going to get totally reversed. The cover is going to happen on the shorts, and they're going to all run up the same stocks they ran down. What do you think of that?
John, I agree with you on most of that. I really do. And yeah, we already saw a correction. I'm not calling for a correction. This is not a gloom and doom forecast on my part. This is simply a recognition that we're going to see some significant uncertainty going forward that we may not even know about now.
So
right?
How should people trade this thing?
I think people should continue to trade whatever their position was coming into this. Things just got better yesterday, right? So there is reason for general optimism, but I think they should be aware that if they're overweight in a sector that's about to become the subject of legislation or political battle, they're going to want to lighten up on that. You're not going to want to ride this one out.
So you're talking healthcare. You're talking banking.
Yes.
You're talking infrastructure was basically industrials.
Absolutely. And again, I think that this is probably a tailwind for the industrials and materials, but you got to pay attention to what's happening in Washington. This is not simply about their earnings. This is about what's going on outside of their control.
Right. And I have to say, to your point, I would say we saw this with the chip stocks this year. When uncertainty towards China trade came, before the trade policy itself, the stocks got shorted. So I think your point is made because hedge funds can take uncertainty of policy and start shorting it even if nothing happens.
Sure.
Right? And that's your basic point.
Absolutely. And I'm glad you brought that up because I have a question for you. You mentioned that having checks and balances is an important part of our government. And so moving toward that is a step forward for American society and for the markets. Do you believe that the new composition of the House is going to act as a check and balance on the trade relations that we're having right now? Is that going to smooth things out?
Great question. I don't think so. I think what's going to make a bigger difference is having the midterm election itself out of the way for the president, because he felt compelled to bring a huge trade attack onto China before the election. I don't think he feels this way 2 years in front of the 2020 election. So I don't think the Democrats are actually opposed to China being roughed up a bit here. And they certainly don't want to see it be on the side of China at this point in time. But I think most of all, I think the president himself is no longer as wedded to this as people think.
Okay. Well, that makes a lot of sense.
Yeah.
I like it.
That's my view.
Sure.
So it's it for us today. That's the Agree to Disagree segment. Dave Borun, John Blank, we hope you liked our ideas about the midterm. I think you can probably tell that we're both reasonably satisfied with what happened, but Dave's point's a good one, which is people will short uncertainty, and there's going to be plenty of it, plenty of contention, and that's what you got to keep in mind here.
Ahead of the Zacks mailbag, here is a list of recent Zacks Ultimate new additions.
Hi, I'm Kevin Matras, and I am here for the mailbag. So this is a question that has come up repeatedly over the last month, given the market's pullback. And really, it's come up for quite a bit over this past year, actually. And that question is, are we headed for a recession? My answer is no, we are not. We are not headed for a recession anytime soon. And I say that because of the facts. So first off, while it's true this is one of the longest expansions we've seen in history, and also one of the longest bull markets we've ever seen as well, the economy isn't showing any signs of slowing. Now, for context, let me just say that over the first 8 years of this recovery, the GDP has averaged 1.48% annually. That was a fine enough recovery. Granted, it was one of the weakest recoveries on record, given that we've never broke 3% annually within that entire time. But it was a fine enough recovery, and we saw the economy heal and the stock market pick up over a 200% return. But in spite of the expansion being a bit long in the tooth right now, the economy is actually gaining steam, not losing it. And that is almost unheard of at this late stage. And that's because of the deregulation we saw in 2017 and the corporate and individual tax cuts we saw in 2018. So, for example, in 2017, the annual GDP was 2.6%, and that means it was more than 70% higher than the average GDP that had preceded it. And full year 2018 is forecast to come in at 3.1% with two of the strongest months to go. And that would effectively put the GDP at twice the average that had preceded it. Now remember, a recession is defined as 2 quarters in a row of negative GDP. But I cannot imagine a scenario that would cause our GDP to suddenly contract into negative territory. Simply put, our economy is strong, and you can see that in virtually every economic metric, from an increasing GDP to historic employment to record consumer confidence and surging corporate earnings. So that brings up the next question. will inflation push the Fed to ratchet up interest rates and cause a recession? That also is a good question, but again, I say no. Inflation has remained under the Fed's 2% inflation target for the longest time. Now, it may poke through there, here and there, but that 2%, that is the desired rate. And a certain amount of inflation is actually good for the economy. And I say that right now we are still in that good space. What the Fed tries to do is they try to prevent destructive inflation, right? The kind of inflation, runaway inflation that ruins the economy. And they do that by raising rates to temper demand. But if you look at where the rates are right now the Fed funds rate is at a midpoint of 2.13%. Now, the market is expecting the Fed to raise one more time by year's end by another 25 basis points. That would bring the Fed funds rate to 2.38%. Now, while some worry that a too aggressive Fed could increase the rate too much and cause a recession, it's interesting to note that in the last 50 years, and 50 years, that encompasses 6 recessions within that time span, there has never been a recession with the Fed funds rate under 4%. Now, looking at the most recent recessions, the Fed funds rate was at 4.24% before the 2007-2009 recession, and it was at 5.31% before the 2001-2002 recession. Looking at the recessions prior to that, it was over 8% each and every time, so I'm not even going to bother going over those. The point is, the Fed is on pace to raise rates 4 times this year. So again, if they raise rates one more time in December, as expected, that'll put the midpoint at 2.38%. The current consensus is that they're likely going to raise rates 3 times next year, and at a 1/4 point each, that'll put the Fed funds rate at 3.13%. And the current consensus also is that they'll raise rates one more time in 2020, putting the Fed funds rate at 3.38%. That will remain below the 4% Fed funds historic threshold, or actually the 4.24% Fed funds historic threshold, before we've ever seen a recession. In fact, that would put us at least a year away, meaning 2021, before even getting into the historical range of even considering a recession. And remember, interest rates are increased to stave off inflation, and that means we would need to see a spectacular economy for that to happen. Not that the economy isn't spectacular right now, because it is, but expectations at this late stage of the expansion are for an impressive 3% annual pace. Those are some of the best numbers we've had in decades, but not so hot where the Fed has to put the brakes on so hard and risk killing the economy. So in my opinion, there is nothing on the horizon to make me believe we are anywhere near a recession. Doesn't mean there won't be any bumps in the road moving forward, because there most certainly will be. But the outlook for the economy and the market is strong, and that is why I remain steadfastly bullish.
Sheraz Mian and Kevin Cook still have the portfolio makeover right after these interesting insights from Zacks Ultimate Editors.
Time for a portfolio makeover, one of our funnest segments to do in the Zacks Ultimate Strategy session. But the hard part is actually picking one portfolio from the dozens that everyone submits. We wish we could get to them all, but I think we're going to have some fun and some instructive lessons with this portfolio from MK, because I think it offers lessons for everybody who's building a longer-term portfolio in wondering, hey, when does this bull market end and how close is the recession? This is a portfolio that I think speaks to the economic cycle because of its heavy concentration in finance and tech. So Sheraz, what do you like here when you look at this and the diversification?
Yes, so it's in terms of the size of the portfolio, we have 27, 28 stocks, a bit on the bigger side, the larger side for my liking, but still.
You mean large? You mean in terms of capitalization?
No, I was going to come to it, but in terms of the size, the overall, the number of stocks in the portfolio, it gets difficult to track 27, 28 and stay on top of them. Particularly if you add to that a tracking list that you are following but not holding. But keeping that aside, excellent stocks here. You have the bluest of blue chips from all of these sectors, technology heavily represented, plenty of finance, plenty of energy, some smattering of other sectors. So
while you go over that, I'm going to show my screen if I could.
Sure.
So they can get a look here at the portfolio. And I've set it up. I'm looking at it by virtue of the Zacks rank. So I've sorted it by virtue of the Zacks rank, so we can see he's got a number 1 up top there with Intel, lots of number 2s.
That's right.
So back to you, Sheraz.
Yeah. So it's very tech heavy. I looked at it on a market cap weighted basis, which may or may not be appropriate depending on how much he holds of each security. But it's about half in tech, and then substantial amount in finance, and then a little bit of energy and a few other sectors. Nothing wrong with that level of heavy concentration in technology, particularly, and in finance, but it needs to be part of some bigger strategy that you have an outlook for technology, you have an outlook for finance, and you have a relatively negative or underweight outlook for these other areas that you are deliberately then underweighting in your holdings too. So on the technology side, what do you think about this? It's a variety of technology here.
So that's a good point. If you're going to have these concentrations, you better have a thesis, right?
That's right.
Yeah. So again, looking at my screen, I clicked on industry rank to sort of give me a sorting by industry rank, so you can see energy, coming up with a really high industry rank in the 20s. I didn't expect that. So you got BP, Royal Dutch Shell, ConocoPhillips. One healthcare in there, United Health, but I should also note that with no industry rank is XBI because it's an ETF for the biotech, equal weighted ETF. So let me get down into where we find the technology companies, and that starts to show up right here with New Republic, PayPal, Facebook, Google, Alphabet, obviously, Okta is a software company, and then you've got Microsoft, Intel. I think there was even a Texas Instruments in here.
Yes, Texas Instruments, Advanced Micro, NVIDIA.
So if I was going to speak to this person and say, is the technology concentration good? Because Amazon in there too. I mean, you could say Amazon, we lump it in technology.
That's right.
But I still think of it as retail because it's 4% of retail sales in the U.S. So do you want to own the FANGs? Facebook, Amazon, Netflix, Google, as this person does, and Microsoft, and I think there's reason to still be long tech. It's not over. Just because we had a valuation correction doesn't mean that that these earnings machines are done doing what they do, and money will still pour into them. So those are the two things I look at. Are the earnings still there?
Yes.
Assuming the economy is stable, the economy is growing.
That's right.
Are the earnings still there for those companies? And they are. And then will institutional investors still support and be investing in those companies? Right. Of course.
Yes.
They're going to be buying Amazon, Google, Netflix, Microsoft. Apple is in here too. So that's how I justify the thesis of owning tech. And I just want to make one comment on the software. Software happens to be exploding today, Wednesday, November 7th, because Twilio reported a great quarter.
That's right.
Everybody loves it. The stock's up 35%. I was telling Sheraz earlier, it's blown through all the raised analyst price targets. You got JP Morgan going from 75 to 85, and the stock's trading 95. Now, that's, post-election, and we're not looking at this portfolio in terms of the election, but it does happen to be the day after. The market has gone up, and money is pouring into software. It's like Sell the semis and buy software has been the theme for 6 months. I kind of missed that trade, but software is the future. So if you can stomach the valuations and pick carefully. So let's shift out of tech. So let's talk about the other concentration area. Sheraz, I like finance late cycle here. You know, just intuitively, what do you say?
So,
I should mention Goldman Sachs,
Morgan Stanley,
JP Morgan, the big banks.
That's right. Yeah, it has all the bulge bracket firms with the exception of Citigroup, and it has both of the pure play investment banks, Goldman and Morgan Stanley. I like the group. I manage the focus list portfolio within ZP. I've loaded that thing up on finance.
Okay.
I have.
So MK's following you here.
I have all the bulge bracket money center banks, a whole bunch of regional banks, the brokers, money managers.
Because of the value or the cycle?
So it's both.
Okay.
The cycle, I don't really buy into we being at the late cycle, as we were discussing earlier in our own discussion. I think there's still plenty of room to go for the cycle, both for the economy as well as for the market. And the big cloud on financials in a macro sense has been this narrative that we are at the end of the cycle. These are deep domestic cyclicals and no point in owning them. On top of that, the interest rate rise thesis, people push back on that argument by saying, yes, margins would nudge up, but they have to pay depositors higher amounts too, so the margins will not grow as much.
And we've actually had a flattening yield curve, that 210 spread getting down to 25 basis points.
Exactly. And then on top of that, there were some secular issues on the trading volume front in capital markets business, particularly in the fixed income and currency side. Loan portfolios haven't been growing as much as should have been the case by this stage of the cycle. But if you look
all that bear case made them values.
Even if you acknowledge all of that, but you are not on board with we are at the end of the cycle, then the financials represent one of the best values in the market. The coming out of the great financial crisis, the 2008, 2009, they have really squeezed expenses out of their operations. The very strict Fed regulations force these guys to really bulk up on capital, so very robust capital positions. And as the administration is easing up a little bit on capital requirements, these guys are paying more and more amounts in dividends and buybacks. On top of that, valuations are very compelling. And the earnings picture, while not as great as Google or Facebook, it's pretty impressive.
Now, in your focus list, did you have any regionals too, or did you just stick with the big?
We have regionals too, yeah. So the co-Americas of the world, the fifth thirds of the world, yes. I believe that that would be, if MK has this positive thesis along the lines of what I have, then the regionals would be a missing link here because they touch on a different part of the economy that the JP Morgans and the Wells Fargos miss out on.
Okay.
So what would be your concluding thing, particularly on the healthcare side?
Yeah, so I mean, if we were just going to look at the last part of this portfolio, one industrial, Caterpillar.
That's right.
I forgot to mention NVIDIA for tech. So in healthcare, really only two holdings. It's United Health, the big healthcare provider, managed care, and then the biotech, which is an equal-weighted ETF.
That's right.
I would want to see more healthcare.
That's right.
After the election here, the HMOs, managed care, have done better too. So maybe a Centene or a Molina. I was actually going to buy Molina today, but it gapped up $10 on me. So. Look for a few more things there, and just owning that equal-weighted ETF in biotech, that seems to make sense for me if you don't want to go out and pick biotech stocks. So overall, we like this portfolio. We think it's instructive about why you might want to concentrate in finance, why you might want to concentrate in tech, but make sure you have a thesis for it, especially if you're going to leave other sectors behind.
That's right.
And here, it's always the no-brainer. If I want to be in retail or consumer discretionary, just buy Amazon and Netflix. I mean, that can be done if you want to simplify things. All right, so that's our take on MK's portfolio. We hope it helped not only MK, but the rest of you. And keep sending us your ideas and questions. Thanks.
Here are a few things you can expect to see coming up. Check out the latest version of the 7 Best Stocks for the Next 30 Days weekly report, where Zacks experts reveal 7 stocks handpicked for immediate profit potential, posted on the Zacks Ultimate homepage. Plus, don't miss the new special report about how the midterms will influence major policy initiatives, how you can shift your investment strategy, and top trades for each election outcome, all posted on the Zacks Ultimate homepage. And remember, the next Zacks Ultimate Strategy session will be posted in early December, so start thinking now of those submissions for the Zacks Mailbag and Portfolio Makeover segments.
Zacks strategist David Borun here with my top pick. It's Nordstrom. I tend to look at general macroeconomic trends, figure out which sectors and industries are best in a position to benefit from them, and then pick the best players in those industries. And Nordstrom is one of those. Right now, the current environment favors the retail sector. There's historically low unemployment, wages are rising, and there have been a series of tax cuts and possibly more tax cuts on the way. Consumer confidence is at an 18-year high. Nordstrom has an interesting combination of very high-end retail stores, off-price stores where they can unload some of the overstock merchandise at attractive prices without cannibalizing their high-end sales, and then also a very well-thought-out digital strategy for selling online. We're going to look at unemployment here real quick. You can see we're at the lowest levels. We touched them briefly at the end of the 90s, beginning of the 2000s, and we otherwise haven't seen unemployment this low since the 60s and early 70s. The release of non-farm payrolls last week was a big surprise. The economy created 250,000 jobs, and wages continue to rise steadily. This is consumer confidence, and you can see it's basically the opposite of unemployment, which is not all that surprising. Also at a multi-year high here, we pulled off the lows after the financial crisis in 2008 and 9, and it's been a steady climb to here. Let's take a look at Nordstrom. You can see Nordstrom had a little bit of a tough spell in 2015 and 16, missed a few earnings, and spent basically the next year and a half in the penalty box until pulling out of the gate this year with an exceptionally strong performance. This is this year for Nordstrom. Basically moving in lockstep with the retail sector, even underperforming the retail sector briefly in the beginning of the summer before really taking off starting in about August. And this is why. So you can see same-store sales were basically flat, just up and down around the midline until the end of 2017, and now we're starting to see really big gains in same-store sales. And this is even more important, their digital penetration. So they're very effective at selling merchandise online, which is, of course, the name of the game now in 2018. And then finally, after the last earnings report, they raised their guidance. You can see from these numbers, this is not spectacular. Not a spectacular raise in guidance, but it's very, very solid. This is a solid company, and I think that they are poised to do well, not only in the next quarter, they report next week, but for several quarters to come. My top stock pick is Nordstrom.
Hello, John Blank, Chief Equity Strategist of Zacks. I'm here with my top stock pick. I'll throw it out there before we move on any further. CDW, ticker CDW. It's an Illinois-based firm, infotech firm with a lot of defense business, and it's either a number 1 or 2 ranked stock today. Great stock, and I'm going to show you why I like it, particularly after this sell-off. However, I want to give you a little flavor for why I still like infotech as a sector, because I am a top-down thinking person. So what I've got for you is sector PEG ratios, price to earnings growth ratios. And if you can't pick out what I'm looking at, look at the pink line at the top, which is the consumer staples. Those were sold off big this year. Look at the bottom one, which is the financials. Those have sunk too. So what you see here in between is all the different choices you have. Infotech is the green line. Now, what I like about the infotech story is you don't want to play to the top because they're too overbought, which is the staples, and you don't want to play the ones that are being shorted, which are the financials. You want to be somewhere towards the top, which is where we are with infotech. So I think CDW, because it's not a chip stock, but an infotech stock, because it has some defense spending that's going to buoy it for sure. You got to like this stock after the pullback. I would be a buyer here. Probably stay with this stock for 6 to 9 months. And that's my call, CDW.
Well, that's this month's Zacks Ultimate Strategy session. Hopefully you found it interesting. Send any feedback to mailbag@zacks.com, and if you have questions about the Zacks Ultimate service itself, don't forget you can always contact your account manager at ultimate@zacks.com or by calling 888-775-8348. International callers should use 312-265-9309. So until next time, thanks for watching. Thanks also to the production crew. And once again, we look forward to sharing success with you for many years to come.